our new Fed Chairman Kevin Warsh, he announced 5 new task forces, and in this episode I want to talk about how they are going to affect you, how you can make sound investment decisions based off of these 5 task forces. But before we get into all of that, we have to have a full understanding of the Fed. I guarantee that 99.99999% of people, even in the government, don't understand how the Fed works, and we're going to try to pull back the layers and explain it as simply as possible. It is very fascinating, and when you are done, you're going to get a whole entire business lesson on how to run your business, how to climb the corporate ladder, and you are also going to make way better decisions about investing. If you understand what money is, then you attract more money because you can match its frequency. You already know how we roll around here. This is not investment advice. This is for informational and entertainment purposes only. I'm not a financial advisor. This is not financial advice. Make sure you do your own due diligence. Every investment, you run the risk of losing your money. Never forget that. With that being said, enjoy the show. So, just a few weeks ago, our new Fed Chairman, Kevin Warsh, he announced 5 new task forces within the Fed as he's entering into this new role. And in this episode, I want to talk about these 5 new task forces, how they are going to affect you, how you can make sound investment decisions based off of these 5 task forces. But before we get into all of that, we have to have a full understanding of the Fed. I guarantee that 99.99999% of people, even in the government, don't understand how the Fed works. And we're going to try to pull back the layers and explain it as simply as possible. It is very fascinating. And when you are done, you're going to get a whole entire business lesson on how to run your business, how to climb the corporate ladder. And you are also going to make way better decisions about investing. And I really can't wait. This is probably, I'm always excited about every episode, but this episode right here, this is fascinating. It's very fascinating because one question that always comes up in every episode that we do is, what is money really? And I think this episode will be able to come way closer to understanding what money is. And if you understand what money is, then from a spiritual perspective, I think you can attract more money because you can match its frequency. If you don't understand what money is,
not too early with the bars now.
I know. I usually save the bars for later. But this is the thing that, like, as I'm looking at this, I'm like, I get it. And here's the thing. None of this is good nor bad. It just is. And so either you're going to match the frequency of money for good or you're going to match the frequency of money for bad. So let's get into it. Here are the 5 task forces that he named. 1, a task force for communication. 2, a task force for managing the balance sheet. 3, a task force for the use of data sources. Number 4, the task force for productivity and jobs. And lastly, inflation. Okay, this means nothing to you now. I'm not even going to try to explain it to you, because if I try to explain it to you right now, you're going to walk away with more questions. We're going to back all the way up. You know I love to give a good history lesson and give some data. So we got to lay it all the way down. This is where it gets really fascinating. Okay, first of all, did you know that we've had 17 or so Fed chairmen, and the Fed has managed a wide range of interest rates, all the way down from near 0 all the way up to 20%. That's what the Fed funds has been, as high as 20%.
No.
Can you believe that?
I did not know that. 20%?
I know.
That's ridiculous.
That is absolutely ridiculous. It actually fixed a big problem that we had.
Wow.
I know. Okay, so first, let's go all the way back. We got to start with the 1600s to put all of this into context.
Okay.
So the 1600s is the first time that a lot of historians believe that in Europe, when they first started fractional reserve banking. Okay, what is fractional reserve banking? Back in the day, we already know that gold was the currency. And so what goldsmiths would do, because like if you needed to buy something, even though gold is relatively light, it's a light metal. If you want to buy something that's big, you can't be lugging around a bunch of gold.
Right.
So what goldsmiths would do was they would allow people to store their gold, and then they would give them a note in exchange. Okay, so hey, you want to store $50 worth of gold here? Here's a piece of paper, boom. And so when you go to buy your refrigerator, it's not for refrigerators in 1600s, but when you go to buy your refrigerator, all you got to do is give him that note. Okay. So what these jokers decided to do was they said, we got $100 over here in gold, and I just wrote him a note. You know what I'm gonna do? I'm gonna double my money. I'm gonna write another note that's backed by that same gold.
Wait, break it down. Hold on.
I know.
I'm gonna write another note.
I'm gonna write another note
that's backed by that same gold. Okay.
This is called fractional reserve banking. This is what all banks do today. I know it sounds very unethical, doesn't it? This is what they do.
Yeah.
Okay, so they started doing this back in the 1600s, and it had some very adverse effects. Things kind of collapsed, and then things change. They move on. Now let's fast forward to this country. Okay, so this concept is not new. Fractional reserve banking.
Right.
It's not new. Okay, I'm not going to bore you with the exact details, but from like the late 1700s into the 1800s, there were a lot of changes revolving around war, our gold backing, and a central bank. We have had two other central banks before the Federal Reserve. Okay, so typically a typical cycle was we went into war, and in our country's efforts to expand the money supply to pay for the wars, Revolutionary War, and even the Civil War, different presidents, in order to finance it, just started issuing notes. They weren't banknotes, just notes. So for instance, Abraham Lincoln, in order to finance the Union side, they issued something called greenbacks. They were not backed by anything. And so those times in history, those notes ended up going to zero. Okay? The other thing, there have been attempts at central banks, not necessarily always correlated to these experiences, where we have had a central bank, and then a few years later, a president came along and was like, no, there is really no need for central banks because it doesn't do anything but benefit people at the very, very top. Okay, like for instance, Thomas Jefferson came in and was like, no, we're not doing this. So they didn't last for very long, all right? So fast forward to like late 1800s, early 1900s. So you got Rockefeller and JP Morgan. They ain't really like each other, but they both was like, we need to be in charge of a central bank for the United States, okay? Their biggest thing was they needed to expand the money supply, and this could be conspiracy, whatever. But they needed to expand the money supplies to pay for the railroads. Because one, they needed to pay for the railroads, but also with the transportation of goods via railroads, it made the cost of things go up. So we need to inject more money. So when I say expand the money supply, that means injecting more money into the system. It sounds good, but hold on for just a second.
Right.
So they tried and tried and tried, and it wasn't really happening. But then 1907, there was a crazy bank run. And here's the other thing. When you don't have a central bank, there is a chance, and even with the gold being a backing, there is a higher chance that just bank runs happen. They happen every so often at a set interval amount of years. They just happen. And so there was a huge bank run in 1907, and so they got busy. They said, okay, we need to sell this idea of a central bank as this lender of last resort to banks, because we need to expand, we need to be able to expand the money supply, and we need to be in charge.
Right.
Take that how you want it. So they met in 1910 in Jekyll Island, okay? A bunch of big jabronis. They met in Jekyll Island. This meeting, they didn't even admit that this meeting happened. I told you about this before. They didn't admit until the 50s. Okay, so they went, it was real clandestine, like, okay, we gonna go with hunting gear, and we gonna get on everybody traveled with just their first name. We got our baseball caps, people don't even know how to hunt, and we just gonna go, and this is what we gonna do. And then they went down to Jekyll Island, I think is right here outside of Georgia,
It
off the
is.
coast of Georgia. Okay.
Yep.
And they got busy day and night for about a week, and was like, we're gonna map this whole thing out. Okay. So, boom, 1913 happened. They finally convinced the government to put this bank in place. This passed in December. Okay, the Federal Reserve. Now, here's the other thing. Most of you who watch this show, y'all know that the Federal Reserve is not officially a part of the government. It's totally independent, and it reports to no one.
Correct.
Okay. The Federal Reserve, the name, in my opinion, was chosen to kind of dupe the people. Like, we're going to make it seem like we're part of the government, but we're not. Okay. So, what a lot of people don't also know, and this is total conspiracy, can't prove none of this. 1913 was also the very first year that they put a permanent income tax in place. That happened in February of that same year. I know.
You said that is a conspiracy?
It's a conspiracy that these two things were linked. I'm going to show you
okay,
why.
that they're linked. Okay.
Why it makes sense in a minute. Real quick, this is a great moment. This is why you need to be on our newsletter list. I break everything down. You need to get the full picture. Some of y'all understand things better when you read it and you see the outline. I know the show is entertaining and I'll be giving y'all game, but I really give a full game away in the newsletter. Go to the link down below, sign up for the newsletter. It is absolutely free. Sign up right now. 1913 was also the very first year that they put a permanent income tax in place. That happened in February of that same year. I know.
You said that is a conspiracy?
It's a conspiracy that these two things were linked. I'm going to show you
why.
why.
That they're linked. Okay.
Why it makes sense in a minute. But here we go. February 1913, federal income tax. Now, at the time, it was only meant to tax very wealthy people. If you made over a certain amount of money, you paid a very little bit of tax. Okay? Because also, you got to keep in mind, anytime we had a war or any new technology, we need to expand the money supply. We have to inject more liquidity into the system.
Right.
So you can really only do it two ways. If you're a corporation, bring in more money by increasing your business. Remember, the United States is a corporation, and the business, as of now, especially after 1913, is taxation. That is our income. So how do you get more money in a corporation? You raise your sales. Do more sales and marketing. So it's like, hey, we need to figure out how to do that. Or the other way to get liquidity is you print more money. The Federal Reserve, that is their whole thing, is this whole ability to inject liquidity and print more money. Okay?
My mind didn't even go there. My mind went to selling assets or you know, like
the assets. So here's the thing. So it's really three things at play here when you look at this. The Federal Reserve itself, the backing of gold. What backs the currency? The backing of gold, job creation, productivity, or if it's not backed by gold, what's going to back this currency? Something. We all have to agree that something backs this currency.
Right.
Okay. The last episode, I don't know if it was the episode that you were on or when you were out last week when I recorded with Dom, where we talked about how the currency is really backed by U.S. Treasuries.
That wasn't our episode.
That wasn't our episode. You could theoretically say that the U.S. currency is backed by U.S. debt, right? Like it's fiat. It's not backed by anything. That's not true. If it's backed by U.S. debt, what is the income of the U.S.? Income tax.
If it's backed
so
by
if
US
a bank,
debt.
so if there's a bank that's saying we're going to be your main bank, that's going to help you control money supply, inject liquidity. Where are you getting your income from? Think like a bank, right? No. Where are you getting your income, or what? Either where are you getting your income from, or what are your assets?
The people.
Hold on, before we go to the people, remember, There have also, too, we've gone on again, off again with a federal bank. We've also gone on again, off again, being backed by gold.
Mm-hmm.
Okay? So, if I'm a bank, hey, what do you want to back this loan with? What income or what asset?
Mm.
So first we're going to say, what asset? Gold. Okay, cool. But guess what? We realize if I'm JP Morgan, and this is just me, if I'm JP Morgan and the rest of these people at Jekyll Island, John D. Rockefeller, and the rest of them, if I'm sitting here and I'm trying to figure out like, all right, we're going to be the bank, but we need to make sure that they can always pay us. We need to have two resources depending on what they got going on. Because they keep falling in and out of level gold. We need to make sure they can tax the people, because this is how the Bank of Britain is set up.
Mm-hmm.
We are set up, we tax the people. We can tax you endlessly. Okay? So, well, I'm not saying that they would tax them endlessly. God save the Queen.
I get what you're saying.
Even though she's not here no more. You understand? No disrespect to them.
The ability to, though.
Right.
Yeah.
So if I'm a bank, this is what I be thinking. Hey, I'm going to give you loans, an endless supply of loans, because the dollar is debt note.
Mm-hmm.
I'm going to give you, like, we can print as much money as we can, but I need some guarantees. Well, y'all can have this on again, off again relationship with gold all you want. I don't care. But you need to be able to tax the people. Right now, there was no permanent federal tax.
Mm.
So, conspiracy. A lot of people believe this. It's not a Nicole's conspiracy.
Mm-hmm.
But when you just look at the timeline, it don't make no sense. February, before we even put this stuff that we've been planning since 1910.
Mm-hmm.
Before we even get to that, the Federal Reserve Act of 1913, that was signed in December, a couple days before Christmas. Before we even get to that, let's make sure they got the backstop for the backstop for the backstop.
Mm.
Okay. Sign right here. Make a sign. They need to pay taxes.
And that was February.
February. Okay. So, they put this law in place. It was only meant to just tax very wealthy people. Then over time, we already know how it happened. It just expanded. The one thing I know about the people that set rules for this country is, I say this all the time, that human beings have problems with addressing glacial problems or glacial things. Our brains are not, if something is moving very, very slowly, we just don't.
Right.
So the people who put policy in place throughout time, they always seem to know, like, let's just start with just a little bit.
They just do enough.
Just do a little bit.
Little Band-Aid here and there.
Yeah, it's not even not a Band-Aid. Let's just poke a little teeny hole. No Band-Aid.
No
just
Band-Aid.
A little hole. Just a little teeny hole. Next week, that little hole is going to go from 1 millimeter to 2 millimeters. They won't notice. Then 2 to 3. The next thing you know, we all just, the water's falling on us. And we dancing to fight to keep it whole in place.
Don't
We didn't even know
how you got wet. You don't even know how you got so wet. You just started out dry.
And this is what they do. I'll explain another instance on this anyway. But y'all can probably compare it to a bunch of things that you've seen in government and history, and this is just how they work. I want you to think about this too in your business, but like, don't think about this in a way of like you're trying to be shady. Nicole's not trying to encourage that. But if change needs to happen, sometimes you have to sacrifice. You have to be patient, and you have to make incremental change. That'd be a lot of people's problems when they start in businesses or when they're trying to make a change in their lives. You want to go all or nothing. I have this conversation with another friend of mine. He tries to do everything all or nothing.
That's very deep.
And when you do things all or nothing and you hold yourself to this ridiculous standard, what you do is you're not very forgiving of yourself when it doesn't, on a day when you don't have all. And so on a day when you don't have all, when you have a nothing, or you have anything less than all, you immediately resorted to nothing. And then that starts the spiral effect of you not trusting yourself. And when you don't trust yourself, you don't have conviction. And we all know that anything you want to manifest in this life, you have to have conviction. So it's not always all or nothing. If you're trying to change something, and this is a quick side. So for instance, I'm about to do this social media class. Actually, by the time this goes out, we'll have already done it. I might post the recording. So for those of you who follow me, you'll see how my page grew overnight, right? On YouTube and on Instagram. Love that for me. But the reason I'm doing the class is because two of my friends separately was like, yo, how did you grow? What did you do differently? And I was like, I did something that a lot of people won't do, is when you go to post, like especially on YouTube, specifically on YouTube, you think that, oh, I'm going to start posting like this, and then, oh man, people are not going to like it. People are not going, or if they don't like it, it's like, oh, I messed up. No, you have to know that your first 50, 100, my first 400 posts were trash. But your only job is to get 1% better. Make one thing, improve one thing. Every time. Stop trying to improve 10 things. Your only job is to improve one thing. And so if the government wants to make a big change, only thing they're going to do is just improve one tiny thing. And then next time I'll do another. And then next thing you know, in 20 to 100 years, my full policy's in place. And you didn't even know it.
Yeah.
Your wheels is turning on that one.
Yeah, because it just makes me think about so much analogies that could go for. But I have been one of those individuals who have been a all or nothing like type of individual. Getting older, I have realized that what you said, 1% better is one thing that me and my friend group, we constantly remind each other every day. I do have this one concept. It's like a theory though, that overnight change actually starts at the decision point though, and then you can move at that glacier pace. But yeah, it just makes me think about how many things that the government has implemented. We can even use AI right now, or it's just slow integration, and to the point where you can't live without it. You won't do anything without AI.
I want to back you up for just a second. You said, I always like to say that those drastic changes start with one decision. I love that you said that, but I want to make sure I adjust, and you can take this for what it's worth. Adjust your thinking just a little bit. Your language suggests that the overnight change in reality happens with the decision. And that's not how it works. The overnight change within you happens with the decision. It may take a while for reality to catch up.
Bar, real bar.
I try.
And that's what the U.S. has been doing all this time, though.
Amen.
That's exactly what you just explained, though. Like, it may take a while for
but they made that decision a long time ago, and I'm okay with it. Yeah.
Now 1913.
1913. Now y'all signing this into law, and now we got a whole entire Federal Reserve. All right. So one of the things that I really want you to see with that history is there are a couple of moving targets here. So one, we have a economy with a Federal Reserve or no Federal Reserve. Two, we have a monetary system that's backed by gold or not backed by gold or some combination thereof. So those two things are actually independent of each other, because we've had a Federal Reserve where our monetary system, our money, was backed by gold. We've had a Federal Reserve where it wasn't. We've also had no Federal Reserve where it was and it wasn't. What I will tell you is these two things, having a Federal Reserve and or gold-backed system, directly, both of them influence inflation. They both influence the value of your money tomorrow. Since we've been talking so much about gold, if this conversation got you thinking differently about gold, here's something worth looking into. One of the reasons why I partner with iTrust Capital is because they allow you to own physical gold inside a self-directed IRA. So instead of just buying gold, you can potentially do it in a tax advantage retirement account. And I'm going to add an extra layer for you. If you have questions about rolling over an old 401k, transferring an IRA, or you just want to understand how it all works, I've arranged for you guys, my community, to have a dedicated iTrust Capital representative. You'll find their contact information in the description below. Just email Ryan. He's going to answer your questions and connect you with the iTrust Capital white glove team to help you set up every step so you can own some gold or some crypto inside a retirement account, or just own gold or crypto outside of a retirement account. Email is down below. Reach out to them and tell them I sent you so you can get a free $100 right in your account. By the way, this video is sponsored by iTrust Capital, and I only partner with companies that I truly believe provide value to you guys, my audience. Back to the convo. What I will tell you is these two things, having a Federal Reserve and or gold-backed system, directly, both of them influence inflation. They both influence the value of your money tomorrow.
Now, when you use the word Federal Reserve, though, are you speaking
Federal Bank?
Indirectly and directly, like, because
we don't have to have a government with a federal bank.
Okay.
With a central bank, I should call it.
Yeah.
Our central bank is called the Federal Reserve.
Right.
You don't have to have it. We've had it 3 different times and periods in between where we did not have it. So a Federal Reserve and or a gold-backed reserve, both of these things affect inflation. Let's first talk about a Federal Reserve. A Federal Reserve affects inflation in the sense that it is a feature of the system. You do not have a Federal Reserve without an amount of inflation, because the whole point is they control the money supply. And so if you control money supply, it's always going to affect inflation. This is why over the past, prior to Warsh coming on, we don't know what his policy is going to be, but for a long time, a long-standing policy is we have a target rate of 2% inflation. What is this saying? We've all become very benign to this statement. Like 2% inflation, that's good for the economy. But the reality is there have been times when we have a gold-backed currency and or no central bank, and inflation is almost at zero for long periods of time. But the perils of that is banks are exposed. They butt naked out here. There is no lender of last resort. And also, when you do have inflation, you also can suffer deflationary periods where you have real deep depressions. This is with a gold-backed system and or no Federal Reserve.
Okay.
So there is, the upside is like inflation stays pretty the same. The value of your dollar today is the same as your value of your dollar tomorrow. But there is no lender of last resort. When a bank goes under, they just go under.
So essentially what I hear is, when I think about like the times that currency is backed by gold, right? Whatever those sayings are, when people say the market is going to do what's best for itself, right? That's what that sounds like.
Yes. And so in a minute, we're going to talk about our last couple Fed chairmen. Alan Greenspan, who just died, that was his thing. So he left office right before 2008 happened. They were warning him. And his defense with doing nothing, he left rates very low, even though it was looking buck wild out here. His defense was he believed that markets would take care of itself. It would automatically price correct itself. If you don't have to a degree, my belief, if you don't have a Federal Reserve and or if you are backed by gold, that will naturally happen. Markets will correct itself. But it's almost like when you put the Fed in place, they cause the problem that they now have to fix, which is we're artificially causing inflation because we have to. When there's no instance in where they inject money, because what happens is when they inject money into the system, like we saw with COVID, it doesn't show up for 18 months, 2 years down the line. And then by that time, they can blame it on something else. So for right now, you could theoretically say that this war with Iran was caused as a scapegoat for the fact that they injected money in the system, a lot of money in the system, and we need a place to explain why we have inflation. This is a theory that y'all can run with if you want to. Because wars always cause inflation.
That's some Nicoleology right there.
This is not a Nicole. I'm not saying this is Nicoleology. Is this a way of thinking? I'm not adopting that.
I can very well see how a person can tie the two. Like, what you just saying that.
Especially, it's funny because, like, I said when we got into this war, that was one of our first videos to go viral. Because the war happened on Friday. We was going to talk about something else. I was like, no, we got to change this. Talked about it on Monday, and I think I published it on Thursday or something like that. And almost everything that I said happened. So a couple of weeks later.
Yeah.
And so one of the things that I said was that we're going to be in this war and or the aftermath of it for at least 3 years, 3 to 10 years. And so every other day, it's like, we're in peace talks. And then I'm not lying. Would they say, we're in peace talks? And I'll just be like, okay. And then what happens the next day? No, we're not. Psych.
Another airstrike.
Got him.
Another close.
Got him.
I don't like what they said today. Press the button.
First of all, they don't have a central government. Who are you talking to? The cousin? Who you talking to? Do you know who you talking to?
Let them tell it. He's not talking to nobody. Because every time he say that he talked to somebody, they say he didn't talk to nobody.
They don't have one person. They got a whole network of situations. Only they know how it works. So he be on the phone. He's talking to the butler. The butler like, yeah, we'll see.
I find it ironic though that
he's talking to Jeffrey.
He is the one who gave us the stimmies. I mean, it kind of also fits into it.
I would have to really sit and think through that conspiracy, because that's like super duper 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 layered.
Yeah.
Because how deep do you want to go? Because they try to say, there's some people that say that COVID was engineered. I don't know, but I'm not gonna go there. So like I said, you got central bank, no central bank, gold back, no gold back, and both of these things affect inflation. Then I'm going to bring something else in that we already talked about before, which is if it's not gold backed, what is it backed by? It has to be backed by future income tax. Okay? So, since the Fed is here and we are not backed by gold, they have two jobs: to manage inflation, because we're causing inflation. So we have to make sure that it stays at a pin. Because in order for us to make money, here's the other thing I want you to think about with inflation. The scary thing about inflation is this: it only benefits the people who are very close to the government and the Fed. So they inject more money to the system. So this is going to affect government contractors, people who are right there as soon as that money gets released. Right? By the time, and so the value of the money is still $1. $1 is $1. By the time that money trickles down to everyday people, the value has dropped.
Oh wow!
Right.
I didn't even look at it like that. But yeah. Dang.
I know.
Dang.
I know. This is another pinhole. So if we can do inflation at 2% and it's always going up versus 0% inflation, which is what a gold-backed system would do. Now keep in mind, before y'all be like, we want gold. Your banks, you can lose money tomorrow.
Yeah.
None of these banks is guaranteed with it. It happens quite often. Also, you have also deflationary periods, which is not good. Okay. So if you're going to have a Federal Reserve, and they're like, let's keep it at 2%. It's nice and cute. You barely notice it.
Mm-hmm.
It's nice and cute. So your job gives you a 2% raise. Inflation's at 2%. You're not really making any money, but I'm very close to the government. So as soon as this money hits, I'm making 2% more than you.
You know what this sounds like? This sounds like, right, when the currency is backed by gold or whatever, based upon how you explain it. This is my personal theory of what I'm listening.
Not Nicole's.
Yeah. But like the way that you explained it, the history of it, when the currency is backed by gold and the banks are exposed and they butt naked, all it really exposes is the mismanagement of things.
When it's backed by gold versus when it's not backed by gold.
Yeah. Versus when it's so like what I'm.
So when it's not backed by gold.
No, when it is backed by gold, right, and you have these deep depressionary periods, right?
It's just a correction.
It exposes the mismanagement behind the scenes of what was going on.
It's just a correction.
But when you have the Federal Reserve, they're like, we
Put
messed
the
up.
Band-Aid over here.
We messed up. All right. Yeah. Just print more.
Let's just make it more complicated. A plus B equals C and Z and D and F and Y and G. Get it? And then the traders be like, okay, candles.
And then by the time they get it, yesterday's price is not today's price.
And they done ran off with earning 2% more of their money at the top. And Jimmy John is like, I got a 2% raise in my job. But yeah, but inflation was 2.5%.
Wow.
Okay.
That's crazy.
I know. But then again, also, I want you to think about, again, I'm only doing this because I'm not telling you what to think.
Mm-hmm.
I like presenting my conspiracies because they're fun,
mm-hmm.
right? But I also want you to see the other side of it. Because what a lot of people will do is they will come on and teach you finance or teach you anything and then only give you their side and you don't know the other side. The other side is we kept having bank failures. When they had that bank failure in 1907, I ain't mad at this. I'm super not mad at this. So JP Morgan was super rich. So they went and locked themselves in. It was like a whole bunch of bank failures, okay? It was one bank that cascaded to a bunch of bank failures. And so they went and locked themselves in and they went over and they looked over all the bank's books and decided who was going to live and survive. This was before Federal Reserve. He was a financier. Who else was a financier? That word is so funny to me. Brandon cracking up. That word is so funny to me because it means nothing. You're a financier.
Say it one more time. What was he?
Financier. No, this is a real fun fact. My mom does air quotes with her whole hand.
Like you would like this.
Financier.
You know you got your own version of that though.
I do.
That's your.
It was a financier.
I'm surprised you didn't do that when you said it. He was a
financier. If that word was not associated with Jeffrey Epstein, I would absolutely call myself a financier because it means nothing. If you pay for anything, my 5-year-old son could be a financier. Okay. He was a financier. So they had all these banks going under. And so I'm not mad. It was just like the ultimate boss move. They've been trying to get a Federal Reserve Bank. Remember, they need more money injected into the economy to pay for the increase of cost of goods because of railroads. And we need more money into the economy because we need to finance these railroads. It's not enough money in the economy. So, that banks went under. Yes, I'll help you. Okay, but so he just stayed up all night just playing God. You go. No, not you. And all the people that stayed, JP Morgan. They had a little face thing with his face on it. JP Morgan.
I'm trying to keep it so professional today. But all I can think about is Hercules. Show me.
JP Morgan. And so he was like, it was a party.
He was a financier.
He said, it's a party for me? Okay, so this is what I need from you. Federal Reserve Bank.
Mm.
It saved you all, including you, United States government.
Mm.
We want to make sure this never happens again. Central Bank final boss. Remember, this is the third time. Okay? All right. I'm going to go back to the statement because I never finished my thought. Central bank versus no central bank. Gold back versus not gold back. All goes into inflation at the cost of other things. That's why I was leaving off at the cost of other things. We want both sides of it. You decide what you want to do. Mm-hmm. Which one do you think is better? Which combination? Central bank, no central bank, or gold, no gold. Which you think is better? All right. So then the other question is, now we need to be able to control interest rates. We need to be able to control job creation, because job creation, since everything is backstop for the backstop, is tax dollars. Mm-hmm. We need to make sure it's enough jobs to support the tax dollars, which backs the currency that we are printing, that we are loaning to you.
It goes so much deeper because there's so many tax breaks for the elite, right? Or for corporations, for, but people who pay the most taxes are your everyday people, your everyday workers.
Now let me go back. There's a book that I'm pretty sure, correct me if I'm wrong, y'all, I read so much. There's a book called Business Adventures. Back when we liked Bill Gates and Warren Buffett, they both said that this was their favorite book. When they said this was like 10 years ago. You couldn't get the book printed. You can only get it in a PDF, and in some kind of way I got it in audio. So you probably could buy the book right now. Actually, I probably need to go buy the book. I'm pretty sure in this book there is a segment where they talk about this, because I just explained to you. Think about what Texas was originally created for, to fund wars and big expansion of things. Because we did taxes before, they just weren't permanent, to fund wars. Okay? And guess who it was for? Rich people.
The elite, yeah.
The pinhole. Now who pays taxes?
Everybody, quote, air quote.
Everyday people. But here's the thing, though. And this is why I want y'all to understand. Some of y'all getting mad. Like, oh, I don't want to say I hate. I disagree when people be like, these corporations don't pay taxes. Or rich people don't pay taxes. But the reality is, tax is not meant for rich people.
It's meant for expansion.
It's meant for everyday people. It's not meant for rich people. Originally, it was meant for rich people. Y'all wasn't complaining then.
Right now, it's meant for the backstop.
Everyday people.
I said right now, it's meant for the backstop, though.
It's meant for everyday people to fund the backstop for the backstop. Well, we in the backstop because we're not gold backed. That got systematically removed in two places. If you don't follow this podcast, the first place was in Bretton Woods. We decided, hey, regular everyday people. Now get this. This is kind of trippy when you think about it like this. I thought about this. So everyday people, before Bretton Woods, which was 1944, their dollars was backed by gold. They can go somewhere, exchange their dollars for gold. Then after Bretton Woods, they said no more. Think about how that would make you. I would lose it if I was an American person. I would lose it. You just confiscated my gold. But people ain't see it that way. Okay, cool. But at that time, foreign governments, institutions, they could redeem their money for gold. And then they pegged our dollar, their money, to our dollars. That was part of Bretton Woods. Then 1969, 1970, a whole bunch of nonsense happened. We talked about this on the last episode. A whole bunch of nonsense happened. 1971, Nixon said, a couple countries got mad. Specifically, I'm thinking about the French. It was like, we about to roll up on you. We want all our gold. And Nixon was like, no. We're no longer redeeming gold to foreign entities at all.
Wow.
And they thought that the United States currency would get completely debased, and it didn't. because everybody at that point had already pegged their currency to us, and we got the euro, the petrodollar, and we got all these things. Y'all rely on this too much. What y'all gonna do?
Dang.
I know. What y'all gonna do? Okay, take this paper money and go home. Now this goes back to an old episode when we talked about sovereign wealth funds, and that whole conversation when I was like, the world is banking on the U.S. people being overconsumption. The world is banking on the U.S. being able to grow our tax base and increase taxes.
See, I never really believed in the term too big to fail. Like, I never really wholeheartedly believed that.
Until it is.
But the way you explaining this right now is opening my eyes up to that concept, though. Like, I don't know.
I don't know either. I this, let me tell you something. This is what people be failing to think about. Like, let's live inside of too big to fail. Like this whole thing that I just explained. This is really big and it's too big to fail. Y'all be forgetting that it's one more big dog.
Definitely always and will forever be one more big dog.
When he say it's over. Because bigger catastrophes have happened in the world. The Roman Empire, gone. The flood, gone.
Yeah.
All the things.
Yeah.
Sodom and Gomorrah,
Gone.
Gone.
I was just thinking that one. That was the one in
the
my head.
Ottoman Empire, gone. Egypt, Cleopatra was the last pharaoh. That was 2,000 years ago. They never ran it back. She messed it up. I always like to tell people, this woman, if you are a woman and you are smart, or if you're a man and you're smart and you are attractive or you're attractive, I want you to remember that Cleopatra ruined a multi-thousand-year-old tradition after chasing after some two of them. She ruined. She was the last pharaoh because she had to get some.
Gone.
So, I'm y'all know, pro-American. I'm just saying, I always want you to expand your mind that there's nothing is too big to fail. If y'all don't know, big dog is God.
Big G, not the little one.
Not Big G, not the little one. The biggest dog. Okay? Do what he want. Okay, so now we can talk about our new Fed Chairman, Warsh. Actually, before we go into Warsh, do you think we should talk about maybe like the last 5 Fed chairmen and their whole tenure? Should we talk about that before we get into Warsh? Or you want to jump into Warsh? Let's talk about the last 5 ones.
Okay, let's talk about the last 5.
Okay, I have some notes because I want to make sure I didn't miss anything. There's a couple things I want to talk about each of these guys. We're going to go from 79 from Paul Volcker all the way down to our homeboy Jerome. Actually, this is probably the best way to do it because that'll be a great segue into Warsh. So, all right, 1979, Paul Volcker. He was from 79 to 87. What he inherited. So what I want to make sure you understand, as they come in, the same way you need to look at presidents too and mark presidencies, as they come in, they're inheriting a problem. Okay, so they have to make sure that they don't disrupt things too much. They fix the problem, but also fix the problem in the best way that they see fit. Okay, so he inherited double-digit inflation, collapsing confidence in the dollar, oil shocks, and wage price spiral. What marked his tenure is that rates raised to nearly 20%. He willingly accepted a deep recession to restore price stability. That's called a hawk. A hawk. He said, no, this is what we doing. We in a recession. This is what it is. Inflation during his tenure was as high as 14%. He got it all the way down to 1.4%. And the Fed funds range was nearly 20%. He got it down to 6%.
Oh, wow.
I know. That's aggressive. All right, let's talk about Alan Greenspan. Alan Greenspan just died. He died at 100, literally last week, from 87 to 2006. So here's the thing about Alan Greenspan. He thought he was a rock star. He did. He used to come and speak to people without speaking. Like, they would look at the size of his briefcase and make judgments on what he gonna do or what he gonna say. Mm-hmm. One of them, what's the name of that movie where they put the hand up? Hunger Games.
Oh.
That was the type of vibes he was on.
Yeah.
Okay. What he inherited. Volcker had largely defeated inflation. That's the guy before him. The challenge became managing globalization and financial markets. So once you defeat inflation, now there's this huge expansion. Mm-hmm. And so this all needs to be balanced. So he had a 1987 crash, the Asian financial market crisis, the dot-com bubble, the long economic expansion. He built the reputation of the maestro. Like I said, he thought he was a rock star. Mm-hmm. Here's some of his problems. Too much faith in self-regulating markets. So he did nothing when the writing was on the wall about the subprime market. Nothing. And people was warning him. He was like, it'll fix itself. I'm the maestro. He did not aggressively address the housing bubble or deteriorating mortgage lending standards. After 2008, he admitted there was a flaw in his belief that financial institutions would protect themselves through self-interest.
Also, during his time frame, though, it was just a lot of opacity, as you would like to say your word.
Opacity city?
Yeah. Mm-hmm. As far as being able to just operate with a lack of transparency. I think that's probably what led to a lot of that going on, too, though.
And so, as we look at him, I think a lot of people, especially two Fed chairmen later, our boy Rome, he did the complete opposite. Mm-hmm. He was a little more transparent. Mm-hmm. But now with this next Fed, we see that he wants to go back to opacity. And I'm going to tell you what the benefit of that is. But really quickly, he saw inflation at 1.5% to 4%, and then the Fed funds rate stayed between 3% to 6.5%. Then Ben Bernanke. That was my guy. He was very handsome. And his height. He just had a whole little look going on. 2006 to 2014. During his tenure, the housing bubble burst, the banking system collapsed, worst financial crisis since the Great Depression. He reinvented modern central banking, introduced quantitative easing, forward guidance. This is him trying to be more transparent. Forward guidance. We're saying, hey, what we think we might do, and we're letting you know what we might do. This is the era in which I came up. Mm-hmm. And so when Jerome started doing this same thing, you read between the lines of what they are saying, and people were doing the opposite. I'm like, maybe because I'm a little older, I'm seeing they say what they mean, and they're very, very intentional. And y'all don't see that we're going to be in this for a minute, and y'all don't see that interest rates, we're nowhere because they're like, hey, we have a target rate of 2%. Target rate of 2%. We will do anything to have a target rate of 2%. And people like, interest rates are going to come down. They'll drop them. No, they're not. We're not even close to 2%. They literally said, we got to see 2%. And if you're going to the Fed meeting and they keep saying, this is what we're going to do, and it's not at 2%, why in the world do y'all think that they're going to bring interest rates down?
Yeah.
But see, I came from this era. When Ben Bernanke, this is what he said, this is what we doing.
But their words hold so much weight, though. Like,
so either you say nothing or you speak forward guidance, which is, hey, if this happens, we will do this, or you say nothing. It is a very serious job, so you're not gonna get too much of what Donald Trump be doing.
Yeah,
which is like, ha ha.
I'm gonna say what I feel when I wake up tomorrow.
Right. I'm gonna wink, wink. Buy Adele. You're not going to get that.
Wink, wink. Buy Adele.
Buy Adele.
It's a great computer. A lot of benefits. A lot of benefits. I think the market's going to do very well this year.
Ben Bernanke, critics argue he normalized extraordinary interventions, encouraged future moral hazard, and permanently expanded the Fed's role in markets, which, as we'll see, Warsh doesn't like that. Supporters argue he prevented another Great Depression. Inflation was at 3.5% all the way down to 0.4%. And then the Fed funds rate was at 5.5%, all the way down to 0.25%, which is,
That's really good.
I know. Well, depends. It's not good or bad, but that's fancy. And that was as he was restoring the housing bubble burst, because inflation was really low. It went all the way down to 0.4%. So when you have inflation be really low like that, you can have rates be low, because then that encourages borrowing. Janet Yellen, 2014 to 2018, economy recovering, enormous Fed balance sheet, near zero interest rates. She carefully normalized policy, gradually raised rates, and began shrinking the balance sheet without disrupting markets. And then she was criticized by some for moving too slowly, allowing asset prices and leverage to continue expanding. Supporters argue she engineered one of the smoothest policy normalizations in history. I love this. People don't even talk about her. I love that. When you have a job like this, you want people not to talk about you. That means you did a good darn job. Inflation, 0% to 2.9%. Fed funds rate was 0% to 2.5%. That was the range. Our boy Rome, 2018 to 2026. He had a normalized economy, which quickly gave way to repeated crises. He was out here in the midst of all of this. He suffered the 2019 repo crisis, COVID, the largest quantitative easing ever, fastest rate hiking cycle since Volcker. Then he did quantitative tightening, regional bank failures. That was a couple years ago during COVID, like SVP Bank. It was like 3 banks that went under. Inflation reaching 40-year highs. Critics argued the Fed waited too long to recognize when inflation kept policy too loose for too long. Others argue he navigated unprecedented crisis with remarkable flexibility. I'm gonna be honest with you. I think he did the best that he could. You know, I just like him. And to be honest, after watching Kevin Warsh, which we'll talk about in a second, he's a little likable too. Very controlled in his speech, very intentional. And the whole point of this episode, I want to talk about how he's handling a transition of leadership. And this is stuff that you can use in your business. He's literally taking a textbook page, a page out of the textbook of the book Good to Great. If you've never read the book, it's literally almost he's read the book and was like, I'm going to do this. If you never read the book, I'm going to give you a brief example and I'm going to show you what he's doing. And after watching his speech, I was like, I know that play. Okay, interest rates for him, 0.1% all the way up to 9.1%, and then back down to 2 to 4%. And then Fed funds rate, the range was 0 to 5.5%. Okay, all right. Now our boy Kevin Warsh, let's talk about what he's walking into. He inherits post-COVID Fed with a massive balance sheet, elevated debt, AI-driven uncertainty, and questions about the institution's role. Everybody's questioning, like, do we need a Fed? You're doing too much. You're not doing too much. You're talking too much. You're not talking too much.
You know, one thing
people
that
are more
I
sophisticated. Go ahead.
One thing I find interesting about that, though, and this is another personal theory about when you speak on something, you have to uphold what you speak on, right? And people hold you accountable for what you said. And so, like, Kevin Warsh is pulling a page out of Greenspan's book because he's saying he's not telling you what his future projections are, like of what he expects, because then everybody's gonna hold you. If you did it, great. If you didn't do it, you didn't.
It's not about holding accountable. I think that's part of the job. You have to be held accountable. It's more about you don't want to manipulate markets.
Well, that's what I mean when I say hold accountable in my terms. Because if you say something and it doesn't happen in the fashion of what you said, according to the markets, like it might send the market in a panic. You know, like it could send the market into just. But
it's less about that. That's the thing. When you try to control whether the market goes into panic or not, that's part of the job that you don't want to do. You don't want to not have it go into panic. You don't want to. You want to not influence it. You have to let the markets do their thing. So it's not about, you don't want to say this because you don't want this to happen or that. That's the whole point. He's like, we're not doing that. I'm not going to say this and then y'all respond this way. They're very aware of the little bit that they do say and how people are going to respond to it. No forward guidance. He literally came out and said, I'm not giving you forward guidance. I'm not telling you what we are going to do if this happens.
Right.
Y'all do your own thing. And they got up there on this first, he's got many more press conferences. They got up there and they tried to ask him a million times, what do you, and he was like, No, I put a statement out, and I'm going to refer back to that statement.
Mm-hmm.
And I'm telling you right now, I'm not doing forward guidance. The regional banks will tell you what they think, what could happen, the predictions that's different than forward guidance.
Mm-hmm.
Hey, we think inflation is going to go here. We think inflation is going to go there. They'll do that. But if you're asking me for forward guidance as, hey, if they think inflation is going to go here, then what will I do? I'm not telling you.
Mm-hmm.
That is not what Rome did.
Mm-hmm.
He said, we are keeping rates elevated till we get down to 2%. That's forward guidance.
Mm-hmm.
We're going to do this if this happens. Now, he didn't do a whole lot of it,
Mm-hmm.
but it did tell you what was going to, and that was the thing that blew my mind, that people were like literally still like confused. He was so strict about it when SVP crashed. I just knew because this was right around the time that they started raising rates.
Mm-hmm.
And he was like,
When you said SVP, he's saying Silicon
Valley Bank.
Silicon Valley?
Yeah, when they collapsed. Right before that, he's like, we are going to get to 2%. And then these 3 little banks collapsed, like just out of nowhere. I'm like, oh snap. He's going to lower rates. No.
Mm-mm.
This is the plan. We're sticking to it. That make sense?
Mm-hmm.
Okay. This one, Warsh said, hey, don't ask me no questions. I'm not going to do it. Mind your business. Go home. Good night. All right. I want to talk about where his thinking is. Maybe about a year ago, he did a talk at the IMF about the Fed, and he was very critical of the Fed. And at the time, he may have known that he was on a short list.
Mm-hmm.
I don't know. But he was very critical of the policies and where he stood with the policies. And so I want to formally introduce you to what you're going to get yourself into. And I'm going to take some highlights away from those talks. Okay?
Mm-hmm.
And I'm only saying this because a lot of you watch the Fed, as you should, for your investing. But you have to understand what you are getting into. You have to understand these personality archetypes. You have to understand what's important to them. And if you think the Fed is going to operate the way that it did before, he's already coming in and telling you that's not what's happening. Let me also back up before I even go into this, okay? In the book, Good to Great talks about, so for those of you who don't know, who've never read the book, there was a multi-decade study by Jim Collins, the author of Good to Great, and this team, where they looked at a bunch of large cap businesses, and they did a lot of study to narrowing it down between companies that were good and companies that were great. And they had some markers that identified companies that were great, very distinct markers. And they looked at the very distinct behaviors between the companies that were great and the companies that were good. And in the book, they talk about a transition of power and how some of these, when these CEOs came and under their regime, they took it to great. How did they make this transition of power? And one of the things that Kevin Warsh did, and when I really studied what he said and I read the transcript and I watched the video, because I watched the video and then I also read the transcript about what it is, these 5 task force. And my biggest takeaway that I got from it, and this is what made me be like, oh, he's taking a page out of the book, is something that y'all always say. You always say, I like the way you think. And one of the things, and I tell y'all this, one of the things about the way I think is you don't assume anything. Most of the time, people walk around here with a rigid set of beliefs about how reality works. Nothing in this reality is fixed. And so what he basically said with these 5 task forces, what I'm going to do is I'm not going to assume anything. We have these task forces in place that will focus on these areas. And this is what the good or the great CEOs did when they came into power into these corporations. They did not assume anything. You could be watching from the outside and you're like, hey, this person da-da-da-da-da-da-da-da, and I would do it this way, and I would do it that way. And the reality is Challenge everything, even your own beliefs. That's how you get to the answer to thinking outside the box and coming up with alternative solutions. Challenge everything. Some of you are like, my main thing is like, start a private equity fund, invest in local businesses. Some of you, before I had this conversation, you think about investing, only thing you can think about was the stock market. Invest in the stock market, invest in the stock market, invest in the stock market. What stocks do I buy? What stocks do I buy? When do I buy? When do I sell? When do I buy?
What you call it? Ticker picker?
Ticker picker.
Ticker picker.
But guess what? Like I have a statement. There's always a third option. Guess what? You can invest somewhere else. And it don't have to be international. It could be right outside your house. Challenge everything. So he came in and he's saying, hey, I want to put together these task forces to challenge the most important things that I see as my experience in working in the Fed. What are these important things? Communication. Obviously, we got to manage the balance sheet. The use of data sources. Here's something else I want you all to know, too. Most of the Fed Reserve banks, which is 12 regional banks, they all have a blog where they do extensive research. They're telling you everything about this economy. Everything. Extensive research. All of them publish differently. Some of them have a blog. Some of them put out white papers. The Fed themselves, they put out a lot of research. They research the crap out of this economy. I don't need you not knowing what's going on. That's crazy. It's all public. Guess what? I'm going to give you the good stuff. So y'all, go find it if you want. But I notice when I'm giving y'all information, sometimes I pull from there because that's valuable stuff. They're literally spending millions of dollars researching and figuring out what's going on before the markets.
That's a gem. That's a real gem.
I'll give you an example. I just posted this. So earlier this year, the federal government said, we're going to, these banks are charging too much money for interest. We're going to put interest rate caps on how much interest they can charge. When you could charge high interest, the word for that is usury. And so we're in usury territory. Okay? So the Fed did a study. Some states adopted it. They picked 3 states and picked a handful of banks to see how they responded under interest rate caps. They did a study called the unintentional effects of interest rate caps. And they said, hey, what happens when we maximize the amount of money that these banks can make on interest for debt? How do they respond? You would think that they will respond by saying, okay, we're going to lower it, we're just not going to make as much money. That's not what they did. They said, okay, so we got tiers. The max cap, the people who are affected by this max interest rate is who? People with the worst credit.
You just said this on, I know where you're going now, because you just said this on your story.
I did.
Yeah.
The people with the worst credit. So like the government says the max you can charge is 20%. You think that's affecting a person with great credit and great income? No. 20%. Woo-hoo. Instead, they did something called credit rationing. They didn't lower the rate. They just said the money that we're not willing to take on risk for maxing out our upside, we'll take on lesser risk and give this and then extend more credit to higher income, better credit rating people. And so how about the ghetto credit card? We're just not going to do it anymore. Okay? This was in the Fed papers. That's not even the tip of the iceberg of the stuff that they be producing. Okay. The whole point was the data sources. That's the 3rd or 4th task force. Number 4, 4th task force, productivity and jobs. Remember, they need to make sure and they need to assess, they need to fully understand what's happening with productivity and jobs. If my job is to lend you guys money based on your productivity and your jobs, we need to understand what's going on.
Mm-hmm.
What is the last guy missing? And I need to have a task force to understand first, before we even do anything, because they was also asking him, what are you going to do with these task forces? He literally said, I'm doing nothing. We're just going to assess the situation right out of the book.
Mm-hmm.
I'm not doing nothing.
Triage.
I just want to find out what's going on. What was he doing? What were they doing? What were they missing? How do y'all operate? What's the culture? Y'all eat donuts on Mondays? What's up? I don't know. I just need to know. What's the task force? We got the task force. What's happening? And the last task force is inflation frameworks. This was something I knew he was going to examine before he came in, because we talked about this. Donald Trump is a dove, which means he wants to make sure that they keep the economy growing, even if it's risking inflation, like not affecting rates to target inflation. We just only care to make sure that everybody's this way.
Mm-hmm.
Jerome was a hawk, which means like, hey, we don't care that banks are collapsing.
Mm-hmm.
We're going to keep rates elevated. Thank you. Good night. We have to target inflation.
But then he elected another hawk.
And he elected another hawk, or he nominated. Okay, because he didn't elect him.
Yeah.
He nominated. We already know how Donald Trump acts. That don't make sense. Oh, they probably had a conversation, and he said, again, remember, you always got to think there's another option. Challenge everything. So we're saying, hey, inflation, rates, this is the relationship that we have with it. We don't have to change. Donald Trump, you're suggesting that we change the relationship. I'm not saying we don't got to change the relationship.
Mm-hmm.
Maybe we need to change how we look at inflation, how we measure it. This way we measure it might not be right.
Mm-hmm.
So if I can give you evidence, if I measure it a different way, that is not what it is. So if I can give you evidence, so one way they've been talking about is called a trimmed mean, which takes out the worst stuff and the best stuff, and you just look at the stuff in the middle. Now the problem with this is, if we're going to use Fed funds rate and some other things to target inflation, if you take out the worst stuff, like energy and things that are really going up in price, those things affect inflation for poor people more. So your policy could potentially not be in the best interest of poor people, because you're doing the trimmed mean. You're taking out the worst and you're taking out the best. And then you're focusing on the middle. And so now inflation is going to look very different. If we're taking out the worst, we're taking out the best. So now inflation might not be that bad. I'm just giving you an example of how looking at inflation different could affect what's happening. So they have a whole task force to say, is this way that we're looking at inflation, is it the most effective?
And that task force is called the who?
It's called the Inflation Frameworks Task Force.
Okay.
Sorry. It's called the Inflation Framework Task Force. Another thing that he believes is that the Fed has experienced mission creep. You know what mission creep is? Mission creep is basically like, hey, you have a goal, like shiny object syndrome. You have a goal, and then you start focusing on some other stuff. So he's basically saying the Fed started getting more involved in politics and policy and this. No, we got a job. Our job is to maintain the money supply and keep jobs intact. And so the Fed started doing other stuff. You getting into fights with Donald Trump. Rome.
Or was Donald Trump getting into fights with him?
Donald Trump definitely was picking on him.
Okay.
On camera. I don't know what's happening behind camera. But Donald Trump was saying stuff and Jerome was like, no. I love how he handled that. He was so unbothered.
He was. Rome was just
he
like...
was unbothered. I would love to know what he went through in his life to get him that
But
like,
most
level
people
of
are
fortitude.
unbothered by Trump, though.
That's not true. I totally disagree. I don't want to go down that road.
Okay.
The other thing is, it's a bunch of critiques that he has. But the last one that I want to talk about is he thinks that the Fed stayed in crisis mode too long. So one of the things that they had in place is quantitative easing, where they had injected a lot of money into the economy. They have a large balance sheet, and he feels like that should have been adjusted. That was in response to COVID. And I guess he feels like this was just like the new norm, and they just maintained the new norm this way. Okay, what can you do about this? I think there's going to be a massive shift to how the Fed addresses this economy. And I'm totally okay with it. To be quite honest with you, the way that people approached it before, where they were just looking at headlines and following what the Fed said, I just thought it was a very juvenile way of looking at investing. So I think right now, this is the time in history where we're going to have to put our thinking caps on, because the Fed is not going to spoon feed us information. With that being said, I'm going to go to something I've said to you guys before. Invest in problems, not headlines. Okay? Always look for who's solving the problem the best. That could be local small businesses, your own businesses, and specifically look at investing in tickers, which I started investing again in the stock market.
What?
I know. You know, I've always dibbled and dabbled, but I've been on some hold. I haven't made any moves lately, but right now I think is the right time. I listen.
You ain't tell me
that.
I
didn't know. I didn't tell you. I did a trade last week and immediately made like literally in a day, because I knew I timed it and everything. I made like 15%. I wish I was on my phone. I wish I could tell you. You gotta see his mouth.
Y'all, Nicole don't tell me nothing when I'm here. Nothing.
I'm sorry. I'm gonna do a couple more trades. These are buy and hold. I'm not doing no day trader nonsense. These are buy and hold. Maybe possibly swing. Depends on how invested I get in this. I'm gonna do a couple more trades. It's a couple more companies I want to research, and then I'm gonna share. I'll do a couple more over the next week or so, and then we may do a segment where I share what I bought. I'll tell you what I bought. I'm really, really proud of myself on this one trade that I did.
Okay.
I know.
All right.
Okay. So yeah, I'm gonna tell you about that. Okay. So yes, invest in problems, not headlines, and that's one of the main things that I did in how I identified this particular trade. Stop looking at the headlines. The headlines means it's already crowded. Invest in the problem. Look for the problem. Okay.
How you say it? The writing is on the wall.
The writing is on the wall, y'all. Okay. Next thing. Follow institutional learning, not institutional capital. I just told you this before. Y'all know I'm gonna try to keep y'all in touch as much as possible. Make sure y'all watch every short, every post that I do. I'm trying to get more content up, and the newsletter. I put as much as I possibly can into the newsletter, between my 2 shorts and my newsletter and this long.
Say that again.
Follow the institutional learning, not the capital. Here's the thing. In this day and age, people don't want to read. They want to read way less and less. The information be right there. It be right there, I promise you. And these people are literally trading and they're not reading the information. And a lot of people is going to end up losing. This is my thoughts. A lot of people is going to end up losing their money, a lot of money, behind chasing after this whole day trader resurgence, as well as, or surgence, not resurgence, as well as the AI trade. And it just is what it is. It's not the first or last time that it'll ever happen. But there's so much other opportunity out there, and the writing's on the wall. Make sure you stay close to the fire. Go look at them Fed reports. You got, if you're bored by reading or boring reading, sorry, I don't know what to tell you. This stuff is written in an academic way. Read it. It be juicy.
Follow institutional learning.
Yes. Then you got some of your favorite hedge funds. They put out really good reports. All this. Find the stuff. Or just follow me. I'll be giving y'all the game.
I think they should follow you.
Just make sure you follow me. Get my book.
I think they should join the community.
Join our community.
I think they should.
I give all the game away. Join our community. The Profit Door is our private investor network. Shout out to all the new members that we got. Shout out.
It was a lot on there today.
I know. Welcome to the family.
And if they want to make some money, I think they should invest in your.
And if you want to make money, Brandon, always do the alley-oop. Finger roll.
Swish.
If you want to make some money, y'all know we have a private equity fund. We're a $15 million fund. We invest in assisted living facilities and apartment buildings where we focus on mental wellness amenities. We're offering a 20% return, a 2.5x equity multiple. So go to the link below to schedule a call. No commitments. Schedule a call if you have some extra capital laying around. We are only taking accredited investors. That's the nature of our fund. Actually, one of just real quick information. There are a couple different types of funds that you can have. In order for me to be able to talk about this on the podcast, we had to file under the exemption 504C exemption, and we can only take accredited investors. If we did 504B, which is not accredited investors, there was a max on how many people we could take in, but also I wouldn't be able to talk about it. And I'm not getting on a podcast and not talking about my fund.
Mm-hmm.
Okay? So if you like the way I think and you know you can run it up with us, let me know. We did a pitch last week. I can send you over the video and you can schedule a call with my team so you can learn more about what we have and what we are doing.
Hot fire flames.
Hot fire flames. That's the flame sound.
Yeah. No.
Flame balls. The other thing I want you to do before we head out of here is invest in and or run businesses that thrive under multiple outcomes. This is another way of me saying picks and shovels, because picks and shovels win under multiple outcomes. Stress test your business. Stress test your business idea. Right now, everything is volatile. Y'all already know. Remember, y'all named me Nicole Volatility Pervy a long time ago. Make sure you invest, especially with everyone predicting a bubble every 5 seconds, the bubble bursting every 5 seconds. I'm not saying it will. I'm not saying it won't. I'm not making that prediction because I don't know. And right now we're in uncharted territory.
Mm-hmm.
For real, uncharted territory. It's a lot of things that's happening right now that we have never seen before. All these different elements. So is it a bubble? Absolutely. When is it going to burst? I don't know. I don't know. And I don't even care. Like real rap, I don't care. This is not I don't care about the American people. This is not that statement. It's not that I don't care, but that's not something I can control, to sit here and try to predict it. All I can do is run my businesses and my investments in a way that it doesn't matter. So for instance, the tickers that I'm looking at right now doesn't matter. That's the only type of businesses y'all want to go chase triple digit returns with some crazy AI bet. You might win, sure. I'm good. I ain't greedy. Run me my picks and shovels money.
Being prepared for whatever.
Being prepared for whatever. I'm not trying to, life will teach you that it's just not worth it to try to be greedy. It's not worth it. If you can achieve internal happiness, I'm not emotionally dependent on some crazy trade going right. If you can achieve internal happiness, you eliminate that need to do wild stuff. Because it's like, I'm good if this works, I'm good if it don't. But I'm make sure it works. But I don't need to go after something buck wild. Brandon over here thinking like a mug.
Now, it just made me think about what you were saying when people buy into the consumerism. Foreign countries buy into the consumerism of the American people.
Oh, and our incessant need to chase buck wild returns?
Greed. Just greed. It's the greed that they know these American people are greedy. Side note, because I know we're close to the end, but did you see, I think it was Norway. I want to say it was Norway. We hosting the FIFA World Cup. Norway rejected eating American food, and they imported like 2,000 pounds. Oh yeah, I sent it to you.
I've been stopped eating it. So one of the things is that they sent them oranges. I've been stopped eating oranges in the U.S. Let me tell you, the first time I stopped eating oranges, the first time I went out of the country, I was 20. I went to Mexico for my birthday with my then boyfriend. And at the time, it was like, don't drink water in Mexico, it give you diarrhea. That was the rumor. This is before the internet, so who knows, the rumor, whatever. So, or the internet existed, but it was before like social media. And so, went to Mexico, trying not to drink no water. And so I was drinking orange juice. And I was like, what kind of oranges is this? Tastes totally different. Totally different. And I was like, that's crazy. And so I'm like, is this like some type of mango orange juice? Because it tasted way better, 10 times better. And so long story short, I then realized like the oranges and the orange juice that they put all type of stuff in our orange juices legally because they can just legally do it. They put all this weird stuff in it and it alters the taste. And then I think I went out of the country like shortly after, like a year later, to a whole different country and had orange juice. I was on the plane and had orange juice and was like, because I thought maybe this was just some Mexican oranges. So I went on the plane. I'm serious. I went on the plane and went to Europe and was like in first class, like, give me some orange juice. Like, what is the whole party in my mouth right now? Like, what is going on? And then I did like a little bit more research about oranges. I just stopped eating oranges here. But orange is a great source of energy.
It goes back to that greed thing. It goes back to because they know the things here aren't probably what's best for the people that's here.
I saw somewhere that it was saying that the other players from other countries was getting sick eating our food.
Dang, I believe it. I know how you feel about the chickens, so.
Chickens ain't real. Chickens made in a lab.